Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is John Azar. He is the founder and managing partner at Peak 15 Capital, a private equity firm specializing in equity and debt across various commercial real estate classes, with a keen focus on high alpha returns through deploying capital from in-house discretionary funds. Peak 15 Capital partners with developers, sponsors, and operators on a variety of asset types and geographic locations. Peak 15 also operates an advisory platform servicing commercial real estate sponsors and developers. John, looking forward to our conversation today.
Thanks so much. Thanks. Appreciate it, Keith. Appreciate you having me.
Yeah. I love to start the show really with your background, where you grew up and what got you into real estate investing and kind of running this firm.
Yeah, where I grew up have completely different from real estate investing, but
Yeah.
I was actually my family are immigrants. I grew up in Syria, Middle East, and my family immigrated to the States when I was 16 years old. So it's
Wow.
It was a rough time for any teenager to move, but nevertheless, to someone who's moved to a new country and doesn't know the language. I didn't know English when I first moved to the United States, and so had to find my way through getting into college, and then moved around all over the place after that, and got into grad school and investments and finance, and just kind of find my way. I would say stumbled my way into real estate to some extent.
Right.
I worked as an equity trader and a wealth manager for Morgan Stanley and shops like Royal Bank of Canada. And we came across a couple of transactions that were really large for supplying bond offerings for a couple of large mixed-use developments. So that got my interest peaked in commercial real estate. The projects themselves, one of them worked, the other one didn't. They were really large. One of them was $800 million, the other one was $1 billion deal.
Yeah.
And from that, we opened, my two partners and I opened our first sort of structured finance advisory platform. It's really, like a better word, we're investment bankers for commercial real estate projects. We worked with developers and a couple of really large family offices that were based in New York and Philadelphia to develop mixed-use development projects for them, anything from urban reuse projects into luxury condos to waterfront development, contaminated projects in Boston in a old Charlestown Navy Yard, to Philadelphia waterfront, to Miami. We even had a consulting project in London. So we did pretty well until about 2008, 2009, and then our business just dried up like a prune
Yep.
You may recall there was something small going on back there. So,
Yeah, exactly.
yeah, a little blip in the market. Well, that blip pretty much drove us out of business. We had to shut down the company in late 2009, 2010. And a few years later, reignited the flame with my brother Tony, who's based here in Charlotte, North Carolina. He already has started a multifamily syndication platform, and I was very intrigued with multifamily. I was involved. I knew about multifamily just from my dealings with Boston Venture Partners. That was my first firm out of Boston that I just mentioned, and we ended up launching a new platform for owner-operator syndication platform based here in the Charlotte area, North Carolina. Operated that until about transacted pretty actively until 2020. We did about anywhere between 5,000 to 6,000 doors during that time. And then in 2021, we started sunsetting a decent part of our portfolio. My brother still runs that side of the company, and so the company's still around, but not as active as we were before. But launched Peak 15 Capital in 21 as a private equity platform for owners and operators and developers. So kind of switched from being the owner operator to more of the capital liquidity providers for the owner operators and developers. Yeah, it's been a wild ride since then, since we launched in 21.
Yeah, sounds like it. That's incredible. And it's probably good to have that lesson that, as much as it probably didn't feel like it when you were going through it, but through 2008, and the having to shut down the business and kind of restart and, reignite what you were doing. Those lessons are always difficult, but sometimes necessary to kind of get to the next level.
Those lessons are great. Actually, these lessons, I'm a huge fan of. You learn more from failures than you do from successes. So I've had more than my fair share of failures, and I value those, to be honest with you, Keith, more than my success. The successes are, they're great. I mean, but you don't learn anything from success. Success doesn't teach you anything. Failure is the one that teaches you a lot.
That's right. That's a good point. And so you kind of got to a spot now where you're sort of on the other side of, the sponsors and really being able to help provide equity. Tell me a little bit about that. What kind of projects do you guys invest in, and what geographical areas are you looking at?
We are we are nationwide. I mean, so we're technically geographically agnostic. We and we're asset type agnostic to some extent. Even though our current portfolio with the fund, we do not have commercial office space. We don't have hospitality. We don't have self-storage, but we do have a variety of other assets. We have, obviously, majority, I would say predominantly our portfolio right now is multifamily. But we also have industrial, flex industrial. We have land plays. We have BTR. We even have a portfolio of car washes in there. So,
oh, nice.
Yeah. It's and there's a method to the madness in everything that comes into our portfolio. There's a balancing act of everything that we try to do, and there's definitely some thoughtfulness behind crafting a portfolio that provides both a balance of cash flow to investors as well as really tremendous growth on the upside. And our fund is a GP fund, so we normally always come into the deals as on part of the GP if we're coming into a deal, and then we provide the GP liquidity in there, and then we partner with institutional partners to come in alongside of us and do the LP JV liquidity part.
Okay, that's interesting. And do you work with a lot of the same, I would imagine, but a lot of the same institutions for that LP portion? Kind of what they're looking for, and you match them up with what investments might work.
We do. They know our underwriting. We know theirs. They know our criteria. We know theirs. We've worked with them before. We have a stable of about 20, 25, 30 institutional partners that we've worked with on a regular basis in the past 5-7 years. So we always kind of, we have our go-tos, and depends on the project and what type it is and how it's structured and the returns. That kind of dictates which ones we should take that project to and which we shouldn't.
Okay. And so kind of as you were kind of growing and learning along the way, maybe let's talk a little bit about and maybe we can start with your hands-on experience as being kind of part of the GP team. I know now you still are part of the GP team, but like on the ones that you've done kind of as being the main person,
right.
The owner operator making it happen. Right. Tell me a little bit about some of the experiences and some of the lessons that you've learned that have kind of helped format your investment philosophy today.
Yeah. I mean, I think the most important part is the sort of the due diligence and being super, super cautious and conservative in your underwriting. I mean, that's something that that can't be overemphasized. You have your assumptions have to be not only based on real world, but they have to also based on a stress scenario real world. So we all want to hope that numbers show us something, but hope is not a method, obviously, and it's not not a strategy. So it's you can if you underwrite and you do your assumptions based on your hope scenario, you're really doing yourself a disfavor, and you're honestly creating a dangerous situation for your investors. You have to do your underwriting and your assumptions and your simulations and your stress testing based on not only real world, but you have to also take into account, I don't want to say worst case scenario, because obviously worst case scenario is an apocalypse. So nobody's going to,
right.
you can't underwrite to the worst case scenario, but you got to underwrite to, how will I do if this property goes down to 80% occupancy or 75% occupancy? Will I still be able to pay my debt service? Will I still be able to at least, be in the even category? And if I do really well, what does that look like? And if I do somewhere in the middle, what does that look like? If you're not stress testing your deal like that, you're really doing yourself a disfavor and your deal a disfavor and your investors as well. So that's really one of the biggest lessons, I'd say. And also, the other lesson is you got to be there. You got to show up and look at, lay eyes on the property and walk the area and see the comps. And, you again, research can only show you so much. Research is one thing. Data is one thing, but actually on the ground, touch and feel, it makes a huge difference, because, there's some things could look completely different on paper and via your research and data, but you go there and you're like, what the heck? That's not what I expected at all. You talk to the property manager, or you talk to opposing property managers, and you get a different feel of like, well, what is this area looking like? Who's coming here? What's going on with this mall? What is this construction, a mile down the road? What is that going to bring? What does it mean to the community? Are people leaving or coming into the community? So these are all factors that obviously some of it you can find out from research and data, but a lot of it you gotta, you can find out a lot more easily and more palatably if you're there in the area in person.
Yeah, for sure. What's a good example? I mean, what's an example of that? So, like one of the times where you've gone on site and been like, "Wow, this is not what I've had the exact same experience where something looks really good. Maybe it's just a property that I'm looking at and I'm like, man, this thing seems to fit all the boxes. And then you drive up and you're like, okay, that's why it hasn't sold yet, or whatever.
Yeah.
But yeah, what are some of those examples that you've experienced?
I'll give you two examples. We looked at a property in Greensboro, North Carolina one time, and it was on paper, again, it looked like in a decent part of town. It looked like it was certainly an area that's, the broker called it transitioning and going into a gentrification mode, and which is fine. I mean, we've done assets in that way before, and we went and looked at it and drove it. And when we went there to drive it, it was not what we expected. The area was a lot more, not quite transitioning as much as as the broker made it out to be. There was a very real presence of police force, and I mean it just didn't look anything like what we were expected. The numbers were great, but when we went and looked at it, we were like, yeah, this is not what was described and what it appeared through in the databases. So we ended up passing on it. We had another property that we went through the bidding process on in north of Charleston, South Carolina, and again presented as it's a North Charleston type of asset, but within a short drive away to North Charleston and the surrounding area, and we went to visit it. It turns out that it was a lot further than it was just a quick drive from there, and it was in an area that just really there was nothing in there, anything around it. I mean, it was the only play. It was the only B-class nice play in that area. I mean, you'd have to drive like a half an hour, 45 minutes to find another complex like that.
Right.
And so that was a red flag for us, and we ended up backing out of that deal. So it's just, those type of things that where you go and touch and feel and see what's going on, and in order for you to make the right determination, because again, on paper and even when you use Google Maps, it's really not going to tell you the full story unless you are there in person. You get the feel of the area and what's going on, and who's there and who's coming and who's going.
Yeah. Makes sense. And then what about, maybe let's just talk a little bit about, you said a lot of the deals that you are providing equity for are currently, like majority of them are multifamily deals. What are you seeing in multifamily right now? I know there's been some struggles really since the rate hikes. I mean, it was on fire before that happened, and it caught a lot of people off guard. There's been some deals that have gone bad. Pricing doesn't seem to have necessarily adjusted back down to what will pencil, what will work. But what are you seeing out there?
The only deals that are making sense right now from a multifamily standpoint are those who have some kind of that have some kind of distress to them, or ground up development. I mean, so it's either distressed deals that are having some sort of financial distress, not necessarily property distress, just finance stress from a capital stack perspective. We've added tremendous amount of assets last year to our portfolio via those type of distressed assets. We bought a huge distressed asset portfolio direct from the lender. We had another distressed asset, a big mixed residential asset, also from a distressed play. Or there are some ground up development opportunities now that are kind of that are showing that there's a huge amount of value built in, because if you have the right land and you have the right location, you have a very good control of your GCs and development costs, both vertical and horizontal, then it could make sense, because the replacement costs in today's market from a development standpoint are certainly, in a lot of markets, have gotten cheaper than they were a year or a year and a half or 2 years ago. But you still face some headwinds. It's not like there's nothing straightforward. I'm not saying that all developments are easy and great and the numbers are better. That's not true. It just depends on really the best possible partner you can have is a really good GC that have a good control on labor and materials that could be involved with you, because that's where the headwinds coming from with a lot of the the crackdown on immigration issues that have been happening in the past year or so. There was a huge loss of workforce in those sectors. We've lost almost, I would say, anywhere between 1 million to 2 million workers across the nation. In those efforts, and that translates into, again, lack of labor for a lot of those assets. So you just got to make sure that's right, and the company that you're partnered with and the GC and the contractor you're partnered with have that already lined up and straight, and they have their own material, and that's how you can keep your cost control down, as opposed to, using numbers from even last year. I mean, even numbers from last year need to be adjusted. So if you priced out something with a GC or a developer last year, you really got to go back and reprice your assets today, because you'd be surprised. Your numbers could look a lot better. Or depends on the asset. It could look worse. It just depends on where it is.
Right. Yeah. Wealthflow audience, pardon me for a quick interruption to today's show, but I have some exciting news that I want to be sure that all of our listeners are aware of. We just launched 3 totally unique to the market funds that are at the cutting edge of technology and AI. We have combined my 25 years of real estate experience and my recent work as VP of development for a tech company to bring 3 awesome investment options to our audience. For full details, go to our website at bobocapitalventures.com. Again, that is BOBO capitalventures.com. All right, back to the show. How about outside of the multifamily? What are some of the others? Well, you mentioned car washes.
Mm-hmm.
Car washes seem like they were hot for quite a while. They're kind of post COVID, sort of in the same time frame where apartment cap rates were getting very compressed. And I know a lot of people like the idea of the car wash because you're working off of EBITDA and a multiplier and some of that, at least on some of those assets. What are some of the things that are attractive to a car wash investment for you?
Yeah, I mean the reason we made the car wash investment because it did have a commercial real estate component to it. That's not like we're not because when people hear that we made a car wash investment, they're going to be like, oh, well, you want to buy laundromats? Like, no, I don't want to buy laundromats. It's there's got to be some. I'm not buying, ATM machines. That's not what, and we have to, our purpose is still very commercial real estate driven. So we have to be very purposeful on what our mission is. So there has to be a real estate growth component to anything we do. Car washes obviously is on the outlier spectrum of what we typically look at. But the reason we looked at it at the time, because it provided the biggest boom for our dollars in terms of cash flow for our investors. I mean, I don't have anything in my portfolio right now that generates the type of cash on cash returns for my investors as the car wash portfolio that we have in there. I mean, that generates anywhere between 15 to 17% cash on cash. I can't duplicate that in anything I have in my portfolio right now. But you do have to be careful. Yes, car washes became very very apropos for after the 21. 22, and especially after KKR made their huge investment back in 22, 23 into a large portfolio of quick quack car washes. I don't know if you remember that. KKR, did almost $1 billion investment into a KKR.
Oh, wow.
Into a quick quack portfolio. Quick quack is, by the way, one of the biggest, if not the biggest, franchisor of car washes in the country. Second to it is Tommy's Car Washes. These are really the 2 biggest franchisors of car washes in the United States. Car washes in general, the car wash industry is very fragmented. There's not a whole lot of big players. A lot of small players, a lot of mom and pops, a lot of private equity now have come in obviously into the business, and they're developing their own brands regionally, nationally, whatever it might be. But it's still very fragmented, and certainly there are a lot of drivers that that are associated with how you underwrite and how you perform the growth into car washes, because it's not like any other a lot of other commercial real estate assets. Not like multifamily. It's not like the numbers. You don't look at them like multifamily or even industrial or self storage, because they're really driven on EBITDA growth and as well as the growth of the real estate itself, but it's mostly on EBITDA. And the way you get there is you calculate. Obviously, memberships are very important. That's a huge important component to it. And then obviously foot traffic and where the location is and how it's located and what kind of area it is. Is it affluent, not affluent? Car washes certainly could face some challenging headwinds in a down economy. It depends on where they are. If they are in a less affluent area, that they will get affected more than car washes that are in more affluent areas or more foot trafficked areas. Not foot traffic, meaning drivability, driving traffic. So the numbers are really calculated, and your underwriting is different in car washes than it is in other asset types. But there are a lot of positives in car washes. Obviously, the depreciation is tremendous. The depreciation, the cost seg that you do, the cost segregation for depreciation in car washes is a lot more juicy than it is in asset types like multifamily, because car washes, the whole building gets depreciated as equipment as opposed to other asset types.
Right. Okay.
So you can depreciate the entire building as equipment within a 2-year period. So your depreciation is so much quicker than multifamily or industrial or anything like that, where those areas, with other areas, it could take you 5, 7, 8 years to fully depreciate. With car washes, you can do it in 2. So you're getting a lot more bang for your buck on depreciation. Obviously, the cash flow is very, very attractive, but again, it depends on location and how well it's positioned and who's operating it for you. The operator is very, very important and the key in the car wash industry. So you gotta make sure that they know what they're doing. They've had, they had a lot of things under their wing that they've operated before. So the experience matter tremendously in those. And we also look for growth play in terms of the land itself. So if they bought this in 5 years ago, or in the next 5 years of this area and this particular piece of land, is that going to offer growth? Obviously, the growth is not just the majority of the growth is not going to happen in just the land itself, but that helps, because if you are deriving tremendous amount of cash flow during the whole time, then you end up selling it and you get another 15, 20% bump in your sale price from what you bought it for. Obviously, that helps your end result and your multiplier. So all of those matters. So it just underwrites differently, but it's still, in my perspective, it's still a good investment. You just got to be very, especially now, you got to be very, very careful on where it is and the location, and really underwrite it and make sure you underwrite the who's operating it and the operation is of it on a day-to-day basis. Who's handling that for you?
Yeah. No, thanks for that explanation. That's great. How about I want to maybe talk about 2 different things, and just see if, say from a general partner standpoint and operator, if they were going to go to Peak 15 Capital and say, "Hey, I'd love for you guys to be part of this deal. I'd love for you to put some equity in." What kind of expectation should they have for utilizing that type of service?
So I mean, principals and GPs come to us not because they only because they need money. So it's not just about a money need per se. They come to us for a variety of reasons. Whether it's developers or owner operators or sponsors. It could be money. It could be because they are they've had they have some limited bandwidth in terms of how much liquidity they can provide as GPs themselves in the deal. They could have a long history of deployment, a long history of performance, and they could also have a decent pipeline of assets that they need to get accomplished or need to get done. And they only have, let's say, $1 million to work with, but they have 3 or 4 assets that they need to put some GP dollars into it. So that limits their liquidity on those. So they'd rather have, they'd rather put less money out of pocket for them into the assets and deploy into multiple assets as opposed to deploying into, blowing all their money on one asset as opposed to 3. So that's where, folks like us can bring in value, where we could help you stretch your dollar from a GP perspective into multiple assets as opposed to just one. That's one reason. Another reason could be because obviously the biggest reason that they come to us is because they know we could also bring in the LP equity to the table. Sometimes from us, from the fund, but most of the time it's from our institutional partners. And that could always be a sort of a lead in for us to evaluate the asset and look at it from our own perspective to see if it's something we want to co-GP on and bring in LP dollars as well and JV dollars. And then, a third reason could be because, they just don't have the balance sheet or liquidity or experience, to take on a bigger project. We're not working with, totally green sponsors. We don't like to work with someone who's just out of the gates. That's just not they're not going to pass our due diligence. But we will work with someone who's done a lot of smaller deals and now they want to graduate into bigger deals. They've done a few raises, friends and family, mom and pop kind of raises, and now they want to graduate into a more sophisticated institutional type of raise, those would be perfect for us because we can come in and partner with them and either bring in one of our institutional investors or partners, or we could do it ourselves with them. It just depends on the situation. So, and they may be a little bit beyond their skids in terms of the balance sheet or experience, and so we can sometimes we could also co-sign with them on deals as a co-guarantor.
Okay. Yeah, makes sense. No, I appreciate that. And then how about if we've got folks that are listening that could be potential LPs? Obviously, you're bringing in some big institutions, so I don't even know if you guys work with more of a retail type investor from an LP standpoint. But what from working with Peak 15 Capital would an LP gain?
Yeah, I mean, the LPs that we work with that come in and invest with us and our fund are just high net worth accredited investors and family offices, small and medium sized family offices. We don't really take on, our fund is not built for institutional investors to come into it. So retail investors are more than welcome to invest with us in our fund. If they're high net worth or accredited. But the institutional LPs like working with us again because of what I mentioned earlier. They know that we vet every deal like it's our own, so they're not getting the usual sort of buckshot approach that you get from a bigger placement shop or the bigger capital markets brokers out there who are who send out an email to thousands of institutional guys. They come in and sort of send in 1,000 emails and hope that somebody will answer them. And that's just not our approach. We don't do that. That's we look at every deal like we're going to do it because we might actually do it. So we have to, so we underwrite the deal. We look at look at the numbers pragmatically. And then we take, and only then we take those numbers to our institutional partners and say, hey, here's this deal. We either situation, either we're coming into it also as GPs and we'd love for you guys to look at it, or we're for some reason or another, we're just not going to be able to come in as GPs, but it is available for you guys to take on as LPs if you want. So they like working with us because again, we know typically their parameters, their underwriting vigors, and they know that we are very picky and very cautiously underwriting deals. So they're not getting someone that is just passing the buck along, whether it's a good deal or a shitty deal. So it's excuse my French, but it's if you continue to do that, I mean, those relationships are very important to us, and in order to safeguard that relationship and make sure that we continue our credibility with those institutional partners, we have to make sure that we're sending them good quality deals that would match their portfolio as opposed to just shoveling anything upstream.
Yeah, no, it makes a lot of sense. You obviously you want to keep those relationships in place, and if you're giving them bad stuff, it's not gonna make, not going to be something that's going to continue for years and years ahead. Very wise there. How about some of the things that you're seeing just right now in the economy, the market? Obviously, we're in a kind of the beginning of the second quarter of 2026. There's a lot going on out there in the world. That causes a little bit of uncertainty. Yeah, exactly. So just curious kind of what you see. I know none of us have a crystal ball, but I always like to, when I'm talking with folks like yourself who have done a ton of deals, and have a pretty good understanding of what's going on out there. I'd love to get your opinion.
Yeah, I mean, look, man, nobody has a crystal ball. If anything, this is the era that we're going through where nobody knows what's going on. I mean, the only certainty there is that there's uncertainty.
Yeah, exactly. It's very true.
I would say that the majority of folks that I've spoken with, that I've connected with over even this year, over some of the conferences I spoke at, and connected with some of our partners and institutional investors, is they're hoping that by the end of the year, and as I am as well, that I'm hoping that by the end of the year, we'll start to see some amelioration in the sort of of what's going on in interest rate and Fed rates and the cap rates out there. will continue to hopefully stabilize towards the end of this year and beginning of next year. So we're all hoping that we're going to see. And again, I don't like to throw around the word hope too much, but honestly, there's no other word I could use right now, because there is no exact data that's given to us. If you go by the data that's given to us, it's we're all going to hell in a handbasket. So that's not something that you want to use.
Right.
You'd really like to use the word hope, because you hope that at some point, calmer heads will prevail, and at some point or another, we are going to get some stability. We are going to get a retention back to sort of the market standards. And by hopefully 2027, you're going to start seeing a lot more stability into the deal dynamics, which means that there's a lot more predictability, and that's what the market likes, especially in commercial real estate. The commercial real estate market likes predictability, especially from a lender's perspective, especially from an equity purveyor's perspective. Nobody wants to invest when they don't know what's going on. So, and that's why when I said earlier, right now, the deals that are really working and making sense completely are distressed deals, because, know that if you're buying something at 50 cents on the dollar, well, it doesn't matter what the market does. Hopefully that if you've done your homework right and you underwrite well, even if you miss it by 10 or 15 bips, 20 bips, 30 bips, your calculation, you're still somewhat safer if you're picking up a distressed assets. But if you're picking up an asset just barely, passing your underwriting and you're skating by the teeth of by the skin of your teeth on your numbers, it's a dangerous place to be, because you just don't know what's going to happen. If you have a 10, 15, 20 points, downwards revision, your numbers are not going to look good. So there's more safety in buying something that is more distress or discounted to market value, as opposed to buying something at market right now, which is, it's very tough. It's very tough to get deals right now to pencil at market, or whatever the brokers are putting it out to be out there. So that's my 2 cents worth on it.
Yeah. Makes sense. Appreciate that. How about did you guys do you guys do any of the lending side as well?
We do not do lending. We're happy to work. We work with a lot of lenders. We're always happy to bring lenders to the table if needs be. If any of our co-sponsors or co-JPs need lending, we're more than happy to show them someone or connect them with someone. But no, we do not do lending ourselves, and also we don't do rescue capital either. Our fund is not built for rescue capital, so that's not. To me, it's just the model doesn't work. Rescue capital doesn't work for me, because if somebody's screwed up a deal, why would I want to co-invest with them and come in and bring my money to rescue them? It doesn't matter how much discount they're going to give us. If they're still on the ground, they're still operating a deal, and they're the one who screwed it up, why would I want to partner with them? So, I'd rather replace them. I'd rather replace them or have them the deal go completely upside down. Not that I want to see people in misery at all. That's not what I mean. But I just mean if you can't manage your deal, and if you're eventually going to end up losing the deal, I'd rather pick it up on the other end as opposed to partner up with you and then try to put in the brain energy and the brain damage to try to make sense of it while you're still in the deal.
Yeah, for sure. When you're looking at some of the multifamily, is there a particular strategy that you look at, like value add? And if so, what are some of the more common value add plays that you guys like to see?
Lately we've really our standards have definitely shifted in the past few years of what type of deals we would look at. We really we try to not look at anything older than 1990s vintage. So really 90s, mid 90s and over are probably our cutoff for the most part. I mean, will I look at something that's 80s in a really good location, good market, and a good asset type, asset class? Sure, I'm not. It's not an absolute no. But for the most part, we really prefer to have newer vintage than anything beyond the 90, because the obsolescence just doesn't make any sense, especially in bad markets or challenging markets like a C-class area or something like that. It's just not worth it. It's not worth the brain damage that you're going to get from it. At least not to us. I'm sure there's going to be a ton of assets out there that are at 70s, 60s, 70s, and 80s that are going to be great for someone who really want to put in the sweat into it and the brain damage into it, and they're going to make a lot of money. I'm sure they will. I'm not saying there's not money to be made there. There certainly is. It's just what are you willing to give up in order to get that? And for us and for our investors, it's just not worth the brain damage for us to go through that. So we really try to keep newer vintage from a and we try to stay in the sort of the B class category. We feel that that's the safest from a multifamily standpoint because B class assets tend to be a lot more resilient to recessionary pressures and economic pressures. A lot of the folks that, when something happened in the economy, the first distress that usually gets felt is either in the A class or the C class. Those, A class folks usually shift downstream into the asset type. So they go into B class because they can, usually the affordability component is still there, but they also get this, very similar amenities and access to amenities and sometimes a lot, almost a similar type of nice amenities and depends on the B class asset, but you can get, similar amenities from A to B, not the same, obviously, but similar. But you also get to save a tremendous amount of money from shifting from A class living to B class living. In C, that's even the same, if not more of a danger. With C class assets, they just stop paying. So you end up having a lot more collection issues and default issues, and you're just having to turn doors a lot more, and it just ends up being a death spiral there. But so that's why we feel B class is really where sort of the in the money for the most part. I'm not saying it's proof. It's completely proof against everything, but that's not the case at all. It depends on the area. I mean, right now, a lot of folks in certain areas and certain geographic areas in the market are suffering no matter what class type they have, whether it's A class, B class, or C class. If there's a prevailing danger in the marketplace of default or fraud or whatever it is, such as, for instance, Atlanta is one area in the country that has been tremendously affected by fraud. Rental frauds in particular, in all asset types, not just, Atlanta's the epicenter of fraud, rental fraud in the country right now.
When you say rental fraud, what do you mean? I just hadn't heard that, but
folks who are what we call them professional renters, those who know exactly how to game the system, and they know how to manipulate the system, and they're forging documents. They're forging W-2s. They're forging employment history. They're forging. They're even sometimes forging identities entirely. There are even companies, believe it or not, in those markets that provide false packages to people. Like you get a package A, you get a false employment record in W-2. Package 2, you get. It's crazy that there are companies actually providing that type of illegal activities, but.
Boy, that makes it super tough to do an actual application on somebody. Then.
Very tough.
It's hard to run through that to begin with. I've had my share of those. We do mobile home parks, and there's we've had our share of some of those where I'm like, man, looking back at this, I don't know that was really even their history, but not near to the extent that what you're saying, you're seeing in Atlanta.
Well, I mean, also, screening tools and due diligence tools have gotten more sophisticated also with AI and everything. So, our tools, our screening tools got better, but also the fraud got better. So you always got to, it's like fighting crime. You got to always keep track of like what's the sophistication there, so you can be a step above it, so you can be able to detect it and catch it and all that kind of stuff. So you really got to be careful these days wherever you're investing, no matter what geographic area you're investing in, and you have to make sure that your property management is on point when it comes to screening and your due diligence, and because it doesn't do you any good to just put butts in beds if those butts are not paying you. So it defeats the purpose. I mean, we drive for economic occupancy, not physical occupancy. Physical occupancy is great, but it doesn't really pay the bills. Economic occupancy is what really is the number you need to pay attention to.
Yeah, absolutely. And if you accidentally get somebody in there that's just physically occupying the space, the amount of money, not just, I mean, they usually are not taking care of the place. So by the time you actually are able to get them out, you're having to do, a turn on that property that is going to cost a whole lot more. It's just, nightmare for sure.
Yeah, it's not worth it. It's just really not worth it. It's just a losing game. So hopefully, that I don't think that's ever going to stop. I mean, that's been with us since the history of rentals. So, that's not something that's going away. There certainly have been an escalation of it in certain markets, but it's just something to watch out for and be careful with, no matter who you rent. I mean, historically, you used to be somewhat, inoculated from that if you were in the upper class area, if you're dealing with A-class assets or, luxury assets or even B-class, B-plus assets. But that's not the case anymore. I mean, that type of stuff is across all asset types, regardless of whether they're A, B, or C.
Wow. Very interesting. Well, John, this has been great. How can people find out more about Peak 15 Capital?
We're go to our site, peak15cap.com. Find me on LinkedIn. I'm under Jalal John Azar or under John Azar. You can even email me directly. It's azar@peak15cap.com.
Perfect. And I've got two other questions I ask every guest. One would just be, any advice you would give somebody who's maybe just starting out in their investment journey?
Oh boy. Just start. There's no, you can't overanalyze everything before you start it. Just start. And I know what I said in the beginning of our show. Don't be afraid to fail. Go ahead and fail. It's early. It's better that you fail in the beginning of your journey than to fail later in your journey. That hurts a lot more when you fail a lot later. So, failure is still going to teach you no matter when you fail, but and it's fine. I mean, don't take it as a negative. It's always a positive. I'm not saying everybody should fail, but don't be afraid of it because it's going to teach you a lot. So it doesn't matter what part of your journey, but it's a lot easier to fail earlier in your journey than it is later in your journey. And it hurts a lot less. So
I agree.
So what I'll tell you is just go ahead and start. Don't overanalyze. Don't get clogged down in analysis paralysis, and just start. If you have a few things, if you're at 80% ready, start something and then figure it out as you're going along, and make sure you're building a good team around you. Make sure you're building some people that you can rely on. Make sure you have access to good lawyers. Make sure you have access to good accountants. Make sure you have, you're connected to good lenders and good brokers and property managers, and start exploring those areas. If you don't know them, that's fine. Start exploring, reach out, partner. This is not a business built on people just being an island on their own. This is a people business, and this is a relationship business. So the more relationship you have in your sphere, the better and more successful you're going to have, and a higher chance of success you're going to have when you have, a circle of relationships around you that are going to be helping with your business, not necessarily as partners, but as either vendors, providers, and it could be partners.
Yeah. That's great. Great advice. How about a book recommendation? Doesn't have to be real estate related, certainly can be something you've read that's been impactful.
Oh man. There are a couple of, I'm reading a book now that's, I'm halfway there, and I like it a lot. It's called The History of Money. It's really good. There's a book that I always recommend for people. It's called The Devil Takes the Hindmost, and it's an older book, but it really walks you through various financial crises, all the way back to the tulip craze of the Netherlands, all the way up to the sort of the most recent SNL crisis and beyond that. It's called The Devil Take the Hindmost, and that's very impactful book. And the third book I always recommend is Hope is Not a Method, and it's a really great book on doing planning, diligent planning, after action reviews. It's written by a U.S. general, and very, very, very good book. And I buy that book for everybody who works for us, as a sort of a welcome on board gift for them.
Perfect. No, that's great. I think I think all three of them might be original recommendations on the show. So I appreciate that.
Sure.
John, this has been fantastic. Thank you so much for being a guest on the Wealth Flow, and I think we'll call it a show.
You're welcome. Thanks so much. I appreciate you having me.
All right. If you're still here, I assume that you found value in today's show and with the guests we interviewed. Please take a minute to subscribe and to review the show. It really helps. Also, wanted to remind you to check out Bobo Capital Ventures to get the first look at our 3 new cutting-edge, first-to-the-market investment opportunities. We have only about 15 spots for each fund for retail investors, and we would love, more than anything else, to have our audience be part of that group of limited partner investors. Thanks for listening to The Wealth Flow, and have a great day.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.